Trading Terminology Part 6. Square off. Square off refers to closing or exiting an open position in the market. In simple terms, it means selling a stock that you previously bought, or buying back a stock that you previously sold short. This term is most commonly used in intraday trading, where traders aim to complete both the entry and exit within the same trading day. By squaring off, traders lock in either profits or losses and avoid holding positions overnight. Long position. A long position refers to buying a stock or asset with the expectation that its price will rise over time. In simple terms, it means purchasing a security because you believe its value will increase, allowing you to sell it later at a higher price for a profit. Short position. A short position involves selling an asset you don't own, with the expectation that its price will decline. In simple terms, you borrow the asset usually from a broker, sell it at the current price, and later buy it back at a lower price to return to the lender, keeping the difference as profit. Risk-to-reward ratio. The risk-to-reward ratio compares the potential loss risk on a trade to the potential gain reward. It's a key part of a trader's strategy to help ensure that, over time, profits outweigh losses. Formula: risk-to-reward ratio equals potential loss divided by potential gain. Most professional traders aim for a minimum risk-to-reward ratio of 1 to 2, meaning the potential reward is at least twice the potential risk. Many prefer a ratio of 1 to 3 or higher to ensure more favorable trade setups. Market sentiment. Market sentiment refers to the overall attitude or mood of investors and traders toward a particular market or asset. It reflects whether participants are feeling bullish, positive, or bearish, negative about future price movements. In short, optimism equals bullish sentiment. Pessimism equals bearish sentiment. Why market sentiment matters. It explains price movements that occur even when fundamentals remain unchanged. It reveals crowd psychology, helping identify potential reversals. It aids in timing entries and exits, especially during emotional extremes like panic selling or overenthusiastic buying. Types of market sentiment. Bullish sentiment. Most traders expect prices to rise, leading to strong buying pressure. Bearish sentiment. Most traders expect prices to fall, resulting in increased selling or shorting. Neutral sentiment. The market lacks a clear direction. Traders typically wait for signals or market-moving events before making moves. Caution. Sentiment is subjective and can shift quickly. It should be used alongside technical or fundamental analysis, not in isolation. Over-reliance on sentiment can lead to poor decisions. Always validate with price action and market structure. After-market order, AMO. An aftermarket order is a type of order that allows traders and investors to place buy or sell orders after regular market hours. You can place aftermarket orders when the stock market is closed. These orders are queued and executed once the market reopens.